Chapter 6-1 Inventories and Cost of Sales. Alright, let's take a look at our EcoMart Retail Soup case for May. This table shows every inventory activity during the month, purchases, sales, and how the units change over time. EcoMart starts the month with 180 packs at $5 each. A few days later, it sells 90 packs at $8, and then buys 240 more at $6. Notice the cost is starting to rise. Mid-month, on May 18th, it sells another 150 packs at $9 each, and near the end of May, it restocks again, 120 packs at $7 each, ending up with 300 packs left in inventory. Now, our goal here isn't just to track quantities, it's to see how different costing methods tell different financial stories. Under the Perpetual system, we'll compute ending inventory and COGS using specific identification, FIFO, and weighted average, LIFOs crossed out here, because IFRS doesn't allow it. Then, we'll prepare a comparative income statement to see how each method affects profit. Finally, under the periodic system, we'll repeat the same process, but this time include LIFO, and compare all four side by side. By the end, you'll see that the method a company chooses doesn't change the physical goods, but it can definitely change the profit, the taxes, and the story the numbers tell. Let's start with the specific identification method under the Perpetual system. Here, each batch of inventory has its own label, A, B, and C, and we know exactly which batch was sold. On May 1st, EcoMart began with 180 packs, labeled Batch A, costing $5 each. On May 6th, it sold 90 packs, and those all came from Batch A. That leaves 90 packs from A still in stock. Then on May 12th, it purchased 240 new packs, labeled Batch B, at $6 each. On May 18th, it sold 150 packs total, specifically, 50 from the remaining Batch A and 100 from Batch B. Finally, on May 24th, it bought 120 more packs, which we'll call Batch C, at $7 each. Now we can compute the totals. Cost of goods sold comes from what was actually sold, 140 units from Batch A at $5, plus 100 units from Batch B at $6, that gives us $1,300. Ending inventory includes what's left, 40 units from A, 140 from B, and 120 from C. Multiply by their respective costs, and we get $1,880 remaining in inventory. So under specific identification, every sale is linked to its actual purchase batch. This method works well when products are unique or easily tracked, like cars or jewelry. Now let's see how the results change under FIFO, first in, first out. This method assumes the earliest units purchased are sold first. So, the 90 units sold on May 6th all come from Batch A. When EcoMart sells 150 more units on May 18th, FIFO continues from the oldest layer, the remaining 90 from A and then 60 from B. The cost of goods sold is therefore 180 at $5 and 60 at $6, totaling $1,260. What remains, 180 units from B and 120 from C, forms the ending inventory, valued at $1,920. FIFO generally produces lower COGS and higher profit when prices are rising. Now let's look at the weighted average method under the perpetual system. This method combines all inventory layers into one blended cost each time a new purchase occurs. EcoMart begins with 180 packs at $5. After selling 90, it purchases 240 more at $6. That's when we calculate a new weighted average cost of $5.73 per unit. The next sale on May 18 uses this new average cost, 150 units sold at $5.73 each, giving a cost of goods sold of $1,310. What remains, 180 units at $5.73 and 120 units at $7, forms the ending inventory, totaling $1,871. Notice how weighted average smooths out price changes, producing results that fall between FIFO and LIFO. Let's compare how each costing method affects the income statement. Sales stay the same, $2,070, but the cost of goods sold changes. FIFO gives the lowest cost at $1,260, specific ID $1,300, and weighted average $1,310. That means FIFO reports the highest gross profit and net income, while weighted average shows the lowest. Why? Because purchase costs are rising from $5 to $6 to $7. FIFO sells the cheaper units first, lowering COGS and boosting profit. Weighted average smooths out the change, landing in the middle. If we used LIFO, profits would drop further since newer, more expensive units are sold first. So, the method you choose doesn't just count inventory, it controls how profit and performance are shown. Now we're moving to the periodic system, starting again with the specific identification method. The key difference here is that, under the periodic system, inventory and cost of goods sold are calculated at the end of the period, not after each transaction. The physical flow of goods, however, is the same as before. EcoMart begins with batch A at $5, purchases batch B at $6, and later batch C at $7. From the sales record, we know that 140 units came from batch A and 100 units came from batch B. That gives us the same total COGS of $1,300. The remaining units, 40 from A, 140 from B, and 120 from C, make up the ending inventory, valued at $1,880. So, even though the numbers match the perpetual result, the timing of the calculation is what separates the periodic approach from the perpetual one. Now, let's apply FIFO under the periodic system. Remember, under the periodic approach, we don't track COGS after each sale, we wait until the end of the period and assume the oldest units were sold first. So, looking at all sales together, 240 units in total, FIFO assigns those sales first to the 180 units from batch A at $5, and then the next 60 units to batch B at $6. That gives us a cost of goods sold of $1,260. The remaining units, 180 from B and 120 from C, make up the ending inventory, valued at $1,920. Notice that the totals are the same as under the perpetual system. The difference is timing. FIFO under both systems assumes the earliest goods are sold first, but the periodic method only updates once, at the end of the month. Unlike FIFO or specific identification, this method combines all units available for sale to find one single average cost. The key idea is simple: we divide total cost by total units, and that gives us an average cost of $5.89 per unit. During the month, 240 units were sold, so the cost of goods sold is $1,414. The remaining 300 units form the ending inventory, also valued at $5.89 each, for a total of $1,767. Notice how this method smooths out price changes. Instead of worrying about which batch was sold, it spreads the cost evenly across all units, producing results that fall right between FIFO and LIFO. Finally, let's apply LIFO, the last in, first out method, under the periodic system. This approach assumes that the newest units are sold first. So, when we total up all sales for the month, we start removing units from the latest purchases first. EcoMart sold 240 units in total, which come from 120 units at $7 and 120 units at $6. That gives us a cost of goods sold of $1,560. The remaining items, 120 units from batch B and 180 from batch A, make up the ending inventory, valued at $1,620. Notice how this pattern flips FIFO. Instead of the older, cheaper units going out first, LIFO pushes out the newer, more expensive goods, raising COGS and lowering profit, a result that often appeals to managers seeking tax savings in periods of rising prices. Let's wrap up what we've learned from the EcoMart case. First, inventory costing methods are rooted in physical inventory flows. Each method, FIFO, LIFO, weighted average, and specific identification, reflects a different way of tracking how goods move in and out of the warehouse. Second, these methods directly affect financial statements. Even though the physical inventory stays the same, the choice of method changes cost of goods sold, ending inventory, and ultimately, net income. Third, from a managerial perspective, this becomes more than just accounting. It's a strategic decision, balancing reported profit, taxes, and performance indicators. And finally, LIFO has a special status. It's accepted under US GAAP, but not under IFRS, meaning international companies can't use it for financial reporting. So, the takeaway is simple: inventory methods don't change the actual goods, they change how those goods are valued, taxed, and interpreted on the financial statements. That's it for Chapter 6-1. Great work, see you in the next session.